Retirement is meant to feel secure, but for many Canadian seniors, the loss of a spouse can suddenly create financial stress. Income drops, taxes change, benefits get confusing, and during an already emotional time, important pension decisions can feel overwhelming. The good news? With the right planning, surviving spouses can protect their income, reduce tax pressure, and avoid costly mistakes. In today's video, we'll walk you through 5 simple, low-risk, and fully legal strategies that help safeguard survivor benefits in Canada. You'll learn how government pensions adjust, how registered accounts transfer, and what steps ensure steady monthly income so your family stays financially protected. Hello, and welcome to Senior Wealth Wisdom. If you're married or planning retirement with a partner, today's topic is incredibly important. When one spouse passes away, household income can change overnight. Government benefits may adjust, taxes can increase, and paperwork can become complicated at the worst possible time. But careful planning can prevent financial disruption. In this video, I'll share 5 practical strategies Canadian seniors can use to protect survivor income, safely, legally, and in full compliance with Canadian tax rules. Let's begin. The first step is understanding how survivor payments work under the Canada Pension Plan. When a contributor passes away, the surviving spouse may receive a monthly survivor pension. The amount depends on factors such as age, contribution history, and whether the survivor already receives CPP. Why this matters? Many seniors assume the surviving spouse continues receiving the same total household CPP amount, but benefits are recalculated. Income can change. How to do it? Review both spouses' CPP statements and estimate survivor income in advance using official retirement tools. Example, if both spouses receive CPP, the survivor benefit is combined but capped at a maximum level. Planning ahead prevents surprises. Benefit, clearer expectations and stable budgeting. Next is Old Age Security, OAS. OAS is based on individual eligibility, not household status. However, taxes and income-tested benefits can shift after one spouse passes away. Why this matters? A single senior may move into a different tax situation, which can affect net income and benefit calculations. How to do it? Reassess total taxable income and check eligibility for programs designed for lower-income single seniors. Example, a surviving spouse may qualify for additional supports if total income decreases. Benefit, better income stability and access to available programs. Registered accounts require careful handling. This includes accounts like Registered Retirement Income Fund, RRIF, and Tax-Free Savings Account, TFSA. Why this matters? Incorrect transfers can trigger unnecessary taxes. How to do it? Ensure your spouse is named as a beneficiary or successor holder where applicable. Direct transfers between spouses are typically tax-deferred when structured properly. Example, a TFSA successor holder can continue the account without affecting contribution room. Benefit, preserves savings and avoids avoidable tax costs. Outdated paperwork is one of the most common retirement mistakes. Why this matters? Incorrect beneficiary designations can delay access to funds and create legal complications. How to do it? Review beneficiary forms on pensions, investment accounts, and insurance policies. Ensure wills and powers of attorney are current. Example, naming an estate instead of a spouse can slow transfers and add probate complexity. Benefit, faster access to funds and reduced legal stress. After losing a spouse, tax brackets and credits change. Why this matters? A surviving spouse may pay more tax on the same income due to loss of income splitting options. How to do it? Adjust withdrawal strategies from RRIFs, use TFSAs for tax-free income flexibility, and review annual income planning. Example, drawing smaller taxable amounts and supplementing with TFSA withdrawals can help manage tax exposure. Benefit: more efficient income and improved cash flow. Rules can change, and each family situation is different. Government benefits depend on eligibility, age, and contribution history. This is not financial advice. Consult a licensed advisor. Let's quickly recap the 5 strategies. Understand CPP survivor benefits, know how OAS adjusts, transfer registered accounts correctly, update beneficiaries and legal documents, and plan for single senior taxes. If you found this helpful, please like the video and subscribe to Senior Wealth Wisdom. And tell us in the comments, which step will you review first?